What's up, everybody? We're back for another awesome episode of Fitness Realty's podcast. This is episode 66. I cannot even believe that we've had that many episodes, so I want to say thank you to all of our supporters. Thanks for being here. And I want to introduce John Stevens from HomeQuest Lending right here with me, and we're going to have some awesome fun time talking about lending. So, John, would you introduce yourself and give us a little personal background?
Absolutely. My name's John Stevens. I grew up in Nevada, came out to go to college at the University of Utah, never left. I'm a huge University of Utah fan and love being here in Utah and, just being a part of the community, and have also been in lending since 2000. So,
Whoa, that is awesome. Let me ask you this. What was it about Utah that just made you stay?
well, I think it's clear that this is a beautiful place. There's a lot to offer here, outdoor activities. Obviously, it was a big detail, but I also really created a great community of friends, and eventually met my wife, and she's essentially from here. And so it just became a nice, easy place to live. The cost of living is good. And I just feel like Utah is a good fit for me. I'm sure a lot of people feel the same way.
Oh, yeah.
Yeah.
Oh, that's awesome. Well, on a side funny note, for all of our BYU fans out there, I mean, we can't help them. Oh, just kidding.
Yeah.
No, I'm just messing around. Okay, well, so how did you get started in lending? What does that look like?
So I had a good friend in college that started mortgage back in '98, and we lived together for a couple of years when we were in school. And I had gone down to Southern California briefly for a publishing job after graduating, and I found that wasn't working out for me. So what I did was I reached out to my friend. He said, "Come on up, let's start this, because this is a lot of opportunity for you. You can help a lot of people. You can make a good living at it." So I said, "Why not?" So I left LA, came back up to Salt Lake, and he had already started his own company by then, and he started showing me the ropes on how things work. And we really started to create a lot of transactions, because at the time I got in, rates were literally in the mid eights. So when I started in 2000, it was 8.5%. And, just with, call it luck, I just happened to step in the industry at the right time as rates were doing this sort of downward curve as time went on over the last 20 plus years. And, obviously the last couple of years during the pandemic, it hit its absolute low in the mid twos for like a 30-year fix. So that was a wild ride, and we benefited greatly, but we learned a lot along the way. And that's really how, it started and where I'm at today. Yeah.
Man, that's so cool. I kind of like to show or showcase that you've had that much length in longevity through this whole thing. So you've seen like the '01 bubble, or .com crash. You've seen the '07, '08 recession, or just complete fall of real estate as a whole. So this is pretty cool. You have so much experience. I think that for our listeners, they will really latch on to how much experience you bring to the table, because you can't just pump 20 years of experience into a newbie and think that they're going to be awesome. So I like to kind of talk about that a little bit.
Sure. Well, the financial crisis was definitely an eye-opener. Everything prior to that was somewhat the wild, wild west. You could do 100% financing, you could do stated income, and there were a lot of people in my position who did that. And the banks were offering those to everyone, all the big banks that. So once the regulations kicked in during the Obama administration, things really tightened up, and a lot of good things took place there. They vetted a lot of people that were not, were somewhat unscrupulous and weren't doing their jobs right, and they kind of corrected the system. But then since then, I do believe that there was somewhat of an over-regulation where the pendulum swung to where everything was somewhat over-regulated. And, then like when Trump took office, he kind of relaxed some of those requirements. And so in the end, like, I think we're in a good place. We're kind of good middle ground right now in the business. It makes sense. If you qualify, it's you're going to know right off. I mean, that bank's going to double check our work to make sure that we've done, everything up to standards, what is currently held in place as law. So,
Oh,
yeah,
that's so cool.
yeah.
That's so cool. Well, let me ask you this then. On this channel, we always bring on industry professionals, and we always kind of just chat about what makes them the best. But I want to really ask you specifically, what is the main reason why people should choose you and HomeQuest Lending over going to Rocket Mortgage or something?
Well, the main reason is we give our clients the power to choose the rate that they want and the program that they want. We're a brokerage, so that means we are approved with many different banks. So we don't just have one set of rates. Like when you go to a credit union, they're going to give you their rate. Whereas we can go to that very credit union ourselves. We can go to many banks. We can go to, other corresponding lending sources and say, okay, you know what? We actually have a better deal for you. Now, here's a copy of your rate sheet. We'll let you decide what rate you want. Maybe you want to pay a little money to buy the rate down,
Mm-hmm.
or perhaps you want to increase the rate and have the lender pay some of your closing costs for you. These are some nuances that aren't really communicated to clients when they're getting a mortgage. So we try to be as transparent as possible with people so they feel like they're involved in the choice, because they should be, because they're the ones that are going to have to make the payments on this mortgage when
Mm-hmm.
time goes forward here. They're going to be stuck with this decision. At least they should be part of that decision. I mean, none of us want to pay debt, but we still have to pay it unless if we don't have the money. And most of us, 90 some odd percent of us, don't have the money to pay cash for a home. So,
Mm-hmm.
let's be full disclosure, and let's make sure that they're involved in that decision. So that I would say is the one big difference that we bring to the table. Is it's a discussion. It's not us just saying, here you go, good luck, take our
Mm-hmm.
rate, whether you like it or not.
Right. I'm really excited to go over that. For everybody listening, we are actually going to look at my personal quote from John here shortly. And so, if you're really interested to see those numbers and what they look like, stay tuned, because I'm going to literally show you my FICO score online. I'm going to show you the rate sheet from John and show you exactly how I'm about to get qualified to buy another house. So, little snippet before we get to that point. John's rate that he quoted me was about a percent and a half, and I say that a percent and a half, not a point and a half, not anything like that, lower than everyone else, and so that's why I'm so excited to showcase this. So it's going to be so awesome. But before we get to that, I want to say, what are some of the things that you can offer outside of just allowing somebody to choose the rate? Maybe like what's the number 2 and number 3 thing that people really want from you as a lender?
I think they want somebody to be a strong communicator. A lot of times you apply and your loan goes to a call center. Like, for instance, if you went to, say, American First or Mountain America, you do have a personal relationship with your loan officer, but their job is also delegated to so many different pieces in that in their web of processing. Whereas here, we have a processor in-house, and we work together as a team. We have our clients' phone numbers programmed into our cell phone numbers. We take calls after hours or on the weekends. We give people that comfort knowing that they are going to get a good service in addition to getting a good deal on their mortgage. I would also say another huge asset we bring is experience. I'm going to kind of reference what you'd said earlier.
Mm-hmm.
When things get tight, when deadlines approach, when people want to close on their homes, or there's hitches that come up, or somebody say gets laid off, or you need to be able to pivot. You need to be able to have somebody that's going to get you to your goal, to the finish line. Maybe we involve, say, a parent to help co-sign because a husband lost his job or took a job for less or was demoted, whatever. You need to be able to change throughout the transaction and save deals, because these are people's lives we're dealing with. This is it's no small matter. We
Mm-hmm.
really care. And yeah, I can't sleep at night if I know someone's got a moving truck and we're supposed to fund the next day, and we're not even at the closing table. So I have to, that's just a personal thing because I have to be accountable to those people. So
Yeah.
I would say experience, accountability, and really good service are what are really going to separate us from other banks and mortgage companies.
Yeah, and I love that piece. My favorite is the communication, um, and we'll kind of hit on this story a little bit later about one of the members that you just closed with one of our staff members, and the communication was so on point, and then you just crushed it for them. So I'm excited to kind of talk about that crazy story after we get through the slides as well, because um, it's a wild, insane story. I've never seen a contract go so long, so I'm super excited to kind of just a few minutes talk about the wild and crazy that we see sometimes.
Sure, sure. Love to explain things how it went down.
Right.
So
Let's say, so how big is your team currently? I know you said you have a processor in house, but what does that really mean for us? And well, then describe the rest of your team if you have any.
well, we have a loan coordinator, we have a processor, and we have other loan officers here. Now, I want to be clear, like a team in the sense that a lot of banks will have a team of people, okay?
Mm-hmm.
And what they do is those banks will have a lot of salaries to cover for these people. So that's part of the reason why the banks are charging higher rates because they have to make more money to cover more salaries. With here, we keep it somewhat lean and mean. We have the necessary people here that have the experience to basically take your application and get all the work done up front. So when you actually do find a home, that process is super smooth. So we have 5 employees here, and we delegate at different instances throughout a transaction. Some of those people are loan officers as well as loan coordinators as well as processors. So I want to be specific though, like when it comes to a team environment, that sometimes connotates that, in a big banking scenario, you've
Mm-hmm.
got this huge payroll. Well, we don't have that. So it's really just knowing the systems and knowing being able to place things and not to deal with any sort of unknowns throughout the transaction. So when you apply with HomeQuest Lending, it's going to be like all the work's done up front for us. So a lot of our work is done on the upfront. We don't want to send out approval letters unless we've done that.
Oh, nice.
So therefore, that team effort brings us to the points when we do draft that approval letter, most of our work's been done. So
Yeah, that's so cool. Something that I love that stood out to me is that the way you have your staff set up to be lean and mean is awesome because that is the cost savings that gets passed on to us as consumers. And I mean, I'm all about paying people for their time and commissions and stuff. I mean, we're in that game as well, and we have that time and experience to add value. But when we have areas that we can cut cost and pass that savings on to our consumer, I love that because then that I mean we that makes us stand out head and shoulders above the rest, right? Because our overhead's so much lower.
absolutely, and I an old friend of mine uses a mantra: pigs get fed, hogs get slaughtered. And
Mm-hmm.
that simply means that we're okay with making less on a transaction because we understand that word of mouth is powerful. And
Mm-hmm.
so a lot of our clients are repeat clients. They're also referrals directly as family and friends from those clients because they know that we're going to be straight up with them in the transaction and that there's not going to be some enigma out here where they don't know if they're getting a good deal. I
Mm-hmm.
mean, we actually even implore our people, hey, go get an estimate and bring us your estimate, upload your estimate. We'll look at it, we'll shop it, and if we don't beat it, we know you've got a good deal already.
Mm-hmm.
But if we can beat it, you're going to get either lower cost or rate or possibly both.
Right.
So those are important details when it comes to the longevity of our business.
Yeah. No, that's
Yeah,
so cool. I love
yeah.
that piece. All right, really quick before we move into my personal numbers and our powerful slide presentation, what are the areas that you can help people in to get a loan? Is it just Utah? Is it outside of Utah? Or are there specific places just in Utah? Kind of explain that to us a little bit.
No, we're actually approved in 5 states. We're approved going from west to east. We're approved in California, Idaho, Utah, Colorado, and Texas.
Nice.
And so, we've really created a good established presence in Idaho. We have done a handful of transactions in California. That's kind of an interesting market.
Hmm.
And we've done a small handful in Colorado and Texas. But word is spreading, and I'm going to kind of revert back to that whole discussion on team. If we start to build a little bit more, we're likely going to have to hire more people. And what mortgage companies are hiring right now, actually most of them are actually letting their staffs
Right.
go because they've oversupplied their ranks with a lot of people to handle volume. And because rates have, I mean, literally doubled in the last 4 months,
Right.
they've had some massive layoffs. I'm sure you've seen it in the headlines in the media.
Oh yeah, for sure. Well, and they were
Yeah.
all just thriving off the refi market for the last 3 years, just going buck wild, and now the refis are not happening, not in the volume they were, I guess.
You're right. In fact, I read a statistic of the National Mortgage Publishing. There's like there's a couple publications,
Hmm.
and they referenced that refi applications year over year are down 76% from
Whoa.
2021. So yeah, you're right. I mean, three-quarters of those refis are gone. I mean, there's always going to be people who need to pull money out of their house,
Yep.
or people who say got into a less advantageous loan up front because their credit had
Right.
some derogatory information on it. So, but there's always going to be refis. But really, we try to focus on helping people purchase homes.
Hmm.
We did throughout the refi boom. We still maintained at least 60% of our business was purchase, and now it's closer to 80 to 85%. So
Nice.
we're not a refi shop, but we certainly do them.
Cool.
Um, we more so focus on making sure the purchases go well, because that's really speaks to the longevity we want to have in the business.
Right. No, I like that a lot. Okay, well, let's switch gears a little bit. Let's switch to my personal life. Okay. All
Okay.
right, everybody, we are transitioning to my personal numbers with John Stevens, and this is going to be really exciting because, well, one, I'm putting all my personal information out there on the glorious interwebs, so that's going to be kind of fun. And then number two, you can actually see some legit numbers, some legitimate answers to people's questions. If you start having questions from seeing my personal numbers, feel free to comment down below and ask us some questions that maybe we didn't touch on, or if you have personal questions about your finances, John can definitely answer those for you. The nice thing that I feel like is, John, something that you bring to the table that I've kind of felt is that there isn't any shame in the numbers, right? Like maybe the income isn't high enough or the FICO score is not high enough. I've always kind of felt like when I've talked to you that you're not like judging anybody about numbers or where they're at in their personal lives. And so I always feel like I want to make sure that people know when they're listening to us that they can contact you and ask questions, because a lot of this stuff is scary, right? Like we never talked about finances growing up. We never talked about money.
Sure.
Money's this like weird behemoth that people just kind of don't talk about a lot. And so I want to make sure that everybody knows that if they're listening and they have questions about their personal side, you're a great resource to just say, hey, what are these numbers? What do they mean to me? How can I get past them? Because you just have this way of explaining it in a way that doesn't feel judgy, right? In a world that's all about judging everyone, I feel like you do a good job of making everybody feel safe and secure that they can be open with you. So just wanted to throw that out there before we started just cracking these numbers wide open.
Well, yeah, I think we all have a different path, TJ, and so or your clients maybe had to go through some financial struggles because they went through a divorce, or they took on too much debt when they were younger, or yeah, I mean, you have to respect everyone's profile, because I have people that can't qualify, and I give them a roadmap and say, let's talk in 6 months. And if they're really serious, they go about doing the things we talk about. They pay
Mm-hmm.
off the debt, they figure things out, and we get them ready to go, and they usually buy a house down the line if they've put that effort in. And yes, I'm glad that I convey that sense of comfort to you, because that's what I try to do with everyone. I don't judge anyone, And everyone has a different path, and and it's to respect that path is certainly a big mantra of ours here.
Yeah. No, that's so cool. All right, let's go to the next slide. So here is my personal FICO score. I put up the FICO scores from Lending Tree, but if you can kind of explain what does this really mean in the lending perspective about FICO scores being poor, fair, good, and then on my personal score, kind of put that into perspective of is that going to get me the best rates, or do I need to bump that up, or where are some thresholds that we can talk about to kind of give people perspective on what that means to them?
Okay, yeah. So to start, see, the banking system, there has to be some sort of like rule of law when it comes to issuing credit, and because in the United States we have FICO scoring for the credit bureaus, that's really a big indicator to a bank if you are worthy to have that bank issue you credit. I personally don't necessarily like FICO scores because I think that they hearken to that whole judgmental thing. Because if someone has a low FICO score but they've really worked their butt off, right, and they're just doing everything they can and they deserve a home, they
Mm-hmm.
shouldn't be judged on the merits of their FICO score alone. Okay, so now looking at your graph here, yes, I think 580 is a really good cutoff as far as like, can you buy a house? Can you refinance your house? In fact, I've done some below 580, but if you have a 580 to say 660, 670 credit score, unfortunately, they kind of categorize you in that fair to modestly good category.
Mm-hmm.
And so what happens is a bank, they want to have a reason to charge you more money, unfortunately. Uh,
Right.
I mean, let's just be real. Like, for instance, if you have a 620 FICO score, they're going to say, okay, we can do this. We verified your income. However, you haven't demonstrated us a rating that's going to allow you access to our best interest rates. And then, so really, if you have a 580 or above, you should be able to qualify for a mortgage. But there's so many other factors that play into that. I don't want to say just by having that score you can buy. It's just that's a minimum that's kind of a standard that a lot of the banking world has set.
Mm-hmm.
So that would be somewhat of a low FICO score where you can still buy. Once you're past that 660, 670 range, then you're jumping into the good, very good. And so 778, it's an excellent FICO score. It's actually an exceptional FICO score. It looks to be in your graph here. It's very good, but most people who are in the high sevens or better yet above 740, that's kind of 740 is kind of that cutoff where it's like, okay, everything is good from here on out. If you get an interest rate 740 versus 778 versus 800, they're all about the same. It's
Gotcha.
when you start going below 740, that's when things start to work against you. And that's where that judgment comes in. So if I want to look at your FICO, if I pull credit and I see a 778, I'm elated because I know that I'm going to be able to deliver a better than average interest rate to you and likely even some better closing costs because you're rewarded for having good credit.
Sweet. Oh, that's awesome. So for everybody kind of listening, is 740 this like magical number that's like, hey, everything above that's just kind of gravy?
Well, I mean, some lenders deviate from that a little bit, but that's just kind of a general rule of thumb. If you're
Cool.
above 740, you're going to be in a good spot. And not to say if you're between say 700 and 740, you're not going to get a good rate. I've got clients in that situation now. They're 702, and you know what? They're getting a good rate too. It's
Yeah.
not quite as good as what they could get at 740, but I made them aware of that and said, hey, here's the rate sheet at 700 versus 740. You
Yeah.
can see this is the difference. This is your reward for having a higher FICO, but this doesn't, I don't want to discount, the work you've already put into your credit.
Yeah. No, that's
Yeah.
cool. I think something to really touch on too that we'll probably hit on a lot is that there's about 1,000 variables in all of these scenarios, and each person, like you've mentioned before, is on their specific path, and no two people have the same specific path. And so, really, I think the beauty of this is gaining the insight, but then knowing that they can just call you and ask questions about their personal path because it's just so different with all the many variables that we all have.
Absolutely. But, another thing that does factor into this, which I didn't mention, is that we know there's really like three, basic loan types. There's a conventional loan, an FHA loan, and a VA loan. Okay.
Mm-hmm.
So now conventional lending is more privately backed. You've heard of Fannie Mae and Freddie Mac.
Mm-hmm.
Whereas FHA insures their mortgage, so it's government backed. And the VA, what they do is they endorse it. Okay. So basically FHA and VA have government backing. What that correlates to with interest rates is, like if you're in an FHA or a VA, a lot of times that whole 740 perimeter that I was telling you about for conventional lending, you don't necessarily have to have the best FICO, as long as you're above like 680 to that, for government backed loans, that being FHA and VA,
Mm-hmm.
they're going to open up the best rates to you there because it's less of a risk to that investor. Because if something were to happen, the government's going to back that loan in the event they don't make their payments. So, again, it's all about risk. It's about what risk do you bring to the table, and so the government actually mitigates a lot of that risk if your FICO is a little lower.
Oh, that's so cool. Oh, I
Yeah.
love that. All right, let's move to the next slide. Oh, sorry. This one still says let's talk about interest rate, but really, we're kind of correlating the interest rate maybe and the warpath of the loan vehicle to if the person's W-2 or if they're 1099, and kind of what are some of the time frames that you have to hold the W-2 position versus 1099?
Okay, good question. So really, every loan application, we need a 2-year work history for either or. Okay.
Mm-hmm.
So there's a lot of nuance, a lot of differences with W-2 and with 1099. But W-2 references a wage earner, so somebody who already pays their taxes before they get paid. That's a more ideal situation. It's pretty cut and dry. But there are people who are W-2 who make commissions and bonuses and overtime, things like that.
Mm-hmm.
But realize that as long as you have a 2-year history as a W-2 person, we're going to be able to use that income. But then the variables of that, like I said, bonuses, commissions, overtime, we actually have to average that. So
Mm-hmm.
let's say you have overtime and you have it for, say, 6 months. Unfortunately, we can't use that because that doesn't demonstrate a long enough period of time, right?
Mm-hmm.
Now, with a conventional loan, interestingly enough, you can have overtime for a minimum of a year, and we can at least space that out over a certain period of time, depending on the investor, for 12 to 24 months.
Oh, wow.
Whereas with those government loans, if you have overtime or commissions, they require a minimum of 2 years on that. Okay.
Whoa.
So W-2 income is pretty set and dry. Now, if I want to, transition to 1099, a lot of people are self-employed, and a lot of people, use that as a basis to write off a lot of their income.
Mm-hmm.
And I totally understand that. But what happens is if you don't pay, you don't play.
Right.
Like really, I mean, it's if you say made $100,000 gross, and then you wrote off $80,000 of that,
Mm-hmm.
and you net 20,000, and you only pay taxes on 20,000, you're going to be awarded that 20,000, which is just under $2,000 a month. It doesn't really help a lot, especially
Right.
with the price points we're in Utah right now. So you have to pay to play. Now, because of that, a lot of people are still stuck in that. There are alternative lending programs for people who are self-employed. There are bank statement programs that allow a lender to look and say the deposits in your business account over the last 2 years and say, okay, we don't need to see the tax returns. We can see this business is cash flowing. They have $10,000 a month in deposits consistently for an entire year or 2 years.
Mm-hmm.
We're going to give them a loan because we know that those people are making money when we can see that in their
Mm-hmm.
bank statements. So there's a growing movement for those type of loans. Ironically, those are the ones that really, fell out when the whole financial crisis took place in 2008-9. So they somewhat made a comeback, but they're more conservative. And in those type of alternative loans, you are going to have to come in with more money down because it is a risk assessment, and therefore, they're going to want to mitigate their risk
Mm-hmm.
by having you come in with more, but you could still qualify. So, there's so many, even though it's just 2 categories here, there are so many different outcomes that each one can, that each one can produce, it's worth a conversation to whomever is here listening, to reach out and at least have that conversation without applying. Hey, I get it all the time. Hey, John, I'm self-employed. I've been self-employed for a year. Can I get a loan? Well, likely not, because it's only been a year. Or, John, I've
Mm-hmm.
been doing it for 2 years. Great, let's see your tax returns. And there's also the mix between. There's people who are self-employed who W-2 themselves. So there's just so many different ways to look at it. It's just worth an in-depth conversation to explore that for each of your buyers.
Yeah. Oh, I like that a lot. On my personal side,
Yep.
since I've been self-employed for the last 4.5, almost 5 years,
Yep.
um, would it be easier for me to go get a normal W-2 job really quick and just hold that for, let's say, 3 or 4 months to qualify?
Well, that's what lenders really don't. I mean, they will let you qualify for that if you want to do that, but you have to be genuine with your intention, because they want to make sure you're not doing that just to facilitate the loan. See what I mean? Like,
Gotcha.
you're changing things up. You've been in this self-employed environment for all these years. And you're like, what? I want to buy a house, so I'm going to go ahead and transition, get out of that, and make money for 3 or 4 months as a W-2 person and go off of that. And it's slightly disingenuous, and they look at that and they think, okay, we can qualify that person, but you're going to have to go through some rigorous questioning and writing letters and explaining that process,
Mm.
in doing so. So it's probably wise, to, if to be genuine about it. If you genuinely want to leave the self-employed world and you want to be W-2 person, absolutely. I would recommend that you would be working that job for a minimum of 90 days, minimum. Some lenders may require 6 months to show that you're not simply doing this to facilitate the transaction. Okay.
Gotcha. Okay.
Yeah.
Noted.
Yeah.
Well, then I probably won't do a W-2 job.
Yeah. Yeah, exactly. Since you're a veteran, therefore you already have a certain portion of your income is W-2. So we can also combine the two, take that income, and then, average it with your self-employed income.
Yeah. No, I like that. All right, let's see. Oh, this is a fun slide. Okay, so chat with us about the interest rates and how the pick your own rate kind of thing works.
Okay, well, it may look complicated, but let's look at the second part of the scenario, 3.75 on the second part of your slide down to 4.3.
Okay, so for everybody, that's like right here down to here.
So at 3.75, that 2131.95 below that just says what your principal and interest is. Okay.
Gotcha.
You slide over, that's the 15-day price. It says 99.865. So basically, that's a discount point. In dollars and cents, you have to pay $621 if you're locking and closing within 15 days to get 3.75. So the next bracket over, the 99.802, it would cost you $911 to get 3.75. Okay, so that is a bona fide discount point. That is essentially you buying your rate down slightly. But now go up to the next rate at 3.875. You'll notice that principal and interest goes to 2164.74. However, that first column, if you were to lock on a 15-day lock, will give you a credit of $2,021. That's true. The lender will actually say to you, we give you $2,000 that you can use to offset your costs.
Whoa.
And most of the time we lock on the next column over, which is a 30-day, because most contracts are about 30 days. And in that instance, you're getting a $1,731 credit. Now, let's say your clients don't have a ton of money to cover their costs, or, let's say they, they want to put more money down and they have less towards costs. Well, we can increase the rate as you go down the line. You see 3.99, 4, 4.1. The same is true. So a good example, at 4.375, which is that bottom number, you go over 2 columns, the lender will actually credit you back $8,438. It seems absurd that this is the case, but this really is how interest rates work. Rates aren't just a simple, hey, this is the rate. Rates have, there's many different hands in rates, and until they're actually given to you in the public, right? The general public is presented rates in a fashion where it's just like, here, this is the rate, this is our fee, take it or leave it, right? But I'm
Mm-hmm.
trying to show you this is that full transparency that we're trying to communicate with our clients and say, hey, do you want 3.99? Do you want to buy it down because rates might not be going down anytime soon?
Mm-hmm.
Or is it more like a matter of cost? Because let's say 4.25 suits you better. You get a $5,998 credit, and the difference in your principal and interest, which is 2264, say versus 3.875 at 2164, the difference there is that's about $100, right?
Mm-hmm.
So instead of getting a $1,700 credit, you're going to get a $5,900 credit. And how many months is it going to take for you to make up that $100 that you're paying extra? There's that conversation we have to have, because everyone has an individual scenario that needs that discussion.
Right. I find with these scenarios, what do you find most common? People lean towards the middle ground, or do you find that people really need the lender credit because they have no closing costs, so they kind of bump the rate up? Or do you find that people love to buy the rate down because they think they're going to be in the house for a long time, which really takes, maybe 7 or 8 years to get that money back that you put into it. So if you're not in a house longer than 7 or 8 years, then it was kind of a wash. So I'm kind of curious, like, what do you see happen most of the time with your clients?
Well, I think things have changed a lot since rates have gone up. I think right now people are more conscious about interest rate because we were locking rates in the low twos back in January, December, right? So
Mm-hmm.
I think rate is more of a focus, and I think more people are willing to spend a little bit more. So I would say more of our clients are at that 3.7 or 3.8, where they're like, okay, we'll get a small lender credit, or we pay a little bit of money, as opposed to going to 4.375 and getting a larger credit. And it also depends on how long they're going to stay in the home. So, let's say it's a starter home, they know they're going to turn it into a rental. Like,
Mm-hmm.
okay, I'll take the 4.3 because I'd rather save the money up front. Then when I rent the place and cash flow, it doesn't really matter to me.
Right.
Or if this is your forever home, yeah, stay at 3.75, because if you don't have any confidence in rates going down anytime soon, then you're going to want to at least, put your, you're going to want to make sure you get the best long-term deal for yourself. And so, I would say we're more at that par area, 3.7 or 3.8 these days.
Nice. Oh, that's awesome. Cool thing that I wanted to showcase here is this is actually the quote you gave me for my personal numbers. Well, so this is pretty awesome to see that I could get a 3.25. Right here, 3.25. If I wanted to bring some cash to lock that in. So that was pretty cool to see because I was just getting regular quotes from other lenders, and I had no room to even second guess it or to even say what I wanted, right? They just said, here's your rate and Merry Christmas. And I was like, well, okay. And then I get your rate sheet, and I'm like, my mind's blown that I could even have a choice to sit at the table and talk about it, because normally you don't get that option.
Right, right. And I think we all like to be able to choose, right? Like,
Yeah.
you don't like to be pushed into a corner and just given one thing.
Mm-hmm.
And it's important that people can choose, because then they're involved in that decision and they don't regret it, because, hey, I was involved in that decision.
Yeah.
Maybe I should have gone for that higher rate and cut my costs lower, but I'm okay with it because I do have a lower rate, which means I have a lower payment. And we'll find other ways to to build our savings again, or
Right.
and at least people they own that. They're more accountable to that.
Yeah.
You know what I mean? Because I think we all have to look back on our history and say, wow, made some good choices or bad choices, but at least I was involved in the choice and it wasn't made for me.
Right. No, I like that a lot. For me personally, I'm probably going to be down here in this higher rate because one day it'll be a rental unit and it'll be fine. But I need to
Yeah,
save the cash up front.
perfect. Yeah.
Yeah, I like that. All right, let's go to talking about payments. This is actually from the loan estimate that you sent me. So this is July of 28. So we're kind of shooting this early, of course. But let's talk about the loan amount, which I think right now, like I said earlier, is going to go down just a little bit because the prices for my neighborhood are just going down for the new builds a little bit. But I
Okay.
do like that we quoted this at that 3.99, so I think there was a little bit of lender credit on that based on the not being 3.75.
Yep.
And then my monthly principal and interest for everybody out there, that's only for the loan itself, not for my HOA, which I'll have a $105 HOA, and then it doesn't have taxes incorporated into that either. Which on
Yep.
this estimate, there's items for taxes and things down below. I just didn't snapshot that. So kind of run through what does it look like for payments nowadays, kind of so we can rough ballpark. I know there's 1,000 variables out there, but let's say I wanted to jump up my purchase price to 500,000. What do you think that would do on my payment? Just kind of ballpark it for us.
Well, for every 10,000 in this price range, you're probably looking at a $60 a month increase. Okay. So
Mm-hmm.
if you're going to go up to 500, that's a $240 increase to your principal and interest. So you're probably somewhere at, 24.30 or something like that. Which, it's a good rule of thumb to keep in mind. For every 10
Mm-hmm.
grand, about $60 more or less, sometimes a little bit more as the loan amount increases.
Gotcha.
But when people ask me that question, it's just kind of a nice rule of thumb to keep in your back pocket, if you do decide to jump above that amount. Yep.
Nice. Oh, that's a cool rule of thumb. So for about every 10,000, $60 up in payment. That's awesome to know. All right.
Yeah, no, remember that, like you said, the taxes and insurances aren't included in that. And
Mm-hmm.
that rule of thumb only applies to principal and interest, because if you're buying a higher priced property, you're also going to be paying higher property taxes as well. So, keep that in mind, because your escrows go up as well a little bit if your price increases.
Yeah. True. Very
Yep.
true. All
Yep.
right, let's go to the next one. Let's talk about cash to close. So, kind of run us through because I think I'm in a VA loan for this one. And then what does this look like for cash to close and things like that? I know we have 4 6s on the page. So if you're a 6 person or you don't like six, sorry about that, everybody.
Yeah, it just so happened to be how the cookie crumbled on that
Right.
estimate. But so closing costs. So for VA and for FHA, the VA endorses your loan. So we quoted this as a VA loan. So the VA charges a funding fee, and there's a chart for that. Just Google VA funding fee chart, and it'll pull up.
Hmm.
And so, like, if you're a disabled veteran, you don't pay that. Okay, that's a real cool perk, and
Nice.
I think it's very just in that if someone's put themselves out there and they're a disabled veteran, they
Hmm.
shouldn't have to pay the funding fee. But for everyone else, it depends. Like, for instance, if you do 100% financing, don't put a dollar down.
Hmm.
On your initial endorsement with VA, you pay 2.3%, okay, of your price, and they tack that onto your loan amount. So that is not money you come out of pocket with, and that's why we have such a difference here.
Uh,
17,016 versus the 6666
uh,
is that your VA funding fee and your escrows are somewhere in that call it $10,000 vicinity,
hmm.
right? Because the VA, in order to endorse your loan, collects that fee. Same thing with FHA. They have what's called an upfront mortgage insurance premium, and that's set. So, but back to VA, if you've used your VA endorsement constantly, they actually increase that, unfortunately. So
Gotcha.
from 2.3 to 3.6. Now, but if you come in with a down payment using your VA endorsement,
Uh-huh.
that actually they charge less. So if
Oh,
you came
nice.
in with 10%, that VA funding fee goes down to like 1.2 or 1.5, depending on if you've used it or not.
Oh, that's
So
cool.
yeah. So the 6666 is more so covering the remaining costs in the loan. Now, also in this day and age, I've been telling people that it's becoming more of a buyer's market, and I've been urging the agent, partners that I work with, I'm urging you that when you make offers,
Hmm.
that you ask the seller to pay some of your closing costs, because that credit from the seller is legitimate, and
Hmm.
it just allows you to keep more money in your pocket. You can put that in the price. Prior to the last few months, sellers, as a buyer, you couldn't ask for seller paid closing costs because it was just such a hot market, and there were just so few properties
Hmm.
and so many offers and multiple offers. Now the pendulum is switching to buyers.
Yep.
And I urge you and all your clients to ask facilitate closing costs. Because once you see an estimate such as this, you're like, okay, I'll ask the seller to pay $6,000 of my closing costs.
Hmm.
And, then hopefully, whatever your earnest money is will kick in and it'll cover the remaining $666.
Hmm.
And hopefully you'll get the remainder of your earnest money back at the closing, which then allows you to, furnish the place to do whatever you want. But keep in mind, it's really switching to a buyer's market. And so this is a good time to be a buyer. It really is.
Right. No, I like that a lot. The cool thing that I wanted to kind of point out, well, maybe two questions is what is the threshold where it becomes more advantageous to switch from VA to conventional on down payment? Is it like if you're going to bring 10%, you might as well do conventional, or are there too many variables to kind of justify that?
There are a lot of variables, but if you come in with 10% and you're on your initial endorsement with VA, paying that 1.2 or probably 1.25%, we'd have to weigh that and say, okay, that 1.25% might equate to, let's call it $6,000. Okay. So
Hmm.
you're going to pay $6,000 extra for a VA loan. Whereas with a conventional loan, you usually don't have as good of an interest rate as you do with a VA. Okay. So let's say the rate on a conventional is more like 4.6 or 4.7.
Hmm.
So we have to weigh that and say, does it behoove you to use your VA entitlement, pay that $6,000 to the VA, or is it a better idea for you to pay, that higher rate so you can maintain your VA endorsement, not have to pay it?
Hmm.
Because I'm actually helping a veteran in Texas who's buying a home here in Utah.
Hmm.
Uh, he needs to free up his VA entitlement in Texas, so we're refinancing his home to a conventional loan. Okay,
Hmm.
so he doesn't have enough entitlement to keep the home that he has as a VA loan in
Hmm.
Texas and buy a new here in Salt Lake with his VA purchasing power. So, again, there's so many different outcomes, but I would go through this discussion with you when the time comes and say, you know what, I would recommend that you do VA because, maybe if we get you 3.7 or 3.8 or 3.9, whatever we get,
Right.
it's a lot better than what's being offered in the general market right now. And hopefully in the future, if rates go down, you could do like a VA Earl, which is an interest rate reduction loan.
Hmm.
That's a nice loan where you don't have to really qualify for it. You just got to prove that you've made your payments. Or maybe we refi you out of it, do it as conventional once rates drop. So when you decide to buy that big home that you want
Hmm.
to end up in, right?
Yeah.
That home you can use your full VA endorsement, put your 10% down, and just get an amazing rate on it. Okay.
Yeah.
Yeah.
No, I like that. I like that. Once again, there's just so many variables and there's so many different ways to kind of slice this pizza that it's pretty awesome to be able to really dial it in for each individual person, right? Like we've said a lot of information throughout this entire presentation that maybe people can internalize, know a little bit more about it, but then the end goal is to make sure that we communicate with you what we're really looking to do. Because I think one thing that stood out to me that you said was that you can still use your VA entitlement, but bring a down payment because it might still be beneficial. And most of the time we always think of, well, I just need to do 100% financing if I'm going to do a VA loan, but that's not the case. There's a lot of different ways that can be done, and so I love that we're bringing a lot of education, a lot of material that people aren't thinking about all the time.
Yeah, yeah. It's worth the discussion. Sometimes when you give me your information, and there's some veterans that don't have a huge down payment. So
Hmm.
I might not offer that to them if they don't have 5 or 10% down.
Right.
To say, hey, you can get a gift from a family member, and maybe you don't have to pay as large of a VA funding fee if you don't have the cash yourself. So again, that's part of that discussion that you want to have with people because no two loans are alike.
Yeah. No, that's so
Yeah.
cool. Well, before we kind of wrap up and get too far along, let's talk about some of the comparisons really quick. I know this is kind of at the bottom of the loan estimate little snapshot. So, what kind of interesting things can you point out on this one before we close up?
Okay, so this is like the old truth in lending statement that's now part of the loan estimate, but
Mm-hmm.
it's just giving you information that if you were to stay in this loan, this is how much you would pay in total and
Mm-hmm.
everything, loan costs, everything. And but of that amount, 44,000 would go to paying down your principal. Not
Mm-hmm.
bad. And an APR is just more like the cost of the loan over the course of the life of the loan.
Mm-hmm.
So we talked about financing that funding fee in from VA, right? Well, that
Mm-hmm.
has an impact on the interest rate because you think about it, you're actually, even though you're paying 3.99%, you finance that extra money that payable to the VA and you're paying interest on that little portion as well, right?
Yep.
So in layman's terms, you're paying a little bit more in interest. Hence, you have a higher APR than you do an actual interest rate. And then lastly, just the total interest percentage is somewhat misleading that if you stay in that loan for 30 years, which almost nobody does, but let's say you
Right.
did, after 30 years, you would actually have paid back to that bank of that price 71.738% of what you initially borrowed. So these banks are making a lot of money. I
Yep.
mean, let's be completely honest. We're all paying interest on everything,
Mm-hmm.
and the VAs here, they also need to operate. They need to make money. So they have a huge impact on your APR. They have a huge impact on your total costs, but they do give you a really good loan program that you can use to buy your place. And it's all about leveraging too. You buy a
Right.
home. Many people bought a home 4 or 5 years ago. Now, are just rolling in equity. They've got $200,000-300,000 at their disposal.
Yep.
So a lot of these numbers don't count because maybe they're just going to cash in, sell their home, take the sale proceeds, and buy a bigger home and do it again. But
Right.
and that's kind of how you grow wealth in real estate.
Yeah, for sure. I love that. Something that I want to point out on this slide in particular is that this is where this loan estimate from you, if you get a loan estimate that's legit from somebody else, this is where you can kind of compare apples to apples and kind of take a look at what rate they were quoting. And then, like what John mentioned earlier in this show, is that if you want to get a second opinion, he does have a link on his website to just punch in your info and get a second opinion on it if somebody else gave you a quote, which I really love. And it's fun to put out there, right? There's a lot of industries that are always like, well, get a second opinion. But in lending, a lot of times people just go to Mountain America and they take the first thing that's put in front of them without getting a second opinion. And I feel like we're doing a big disservice to the public by just giving one option. And so I love to have choices and I love to have a second opinion from you, John, because that makes it so that we can all kind of make better decisions. So that's cool.
Yeah, it's a win-win. It basically says, hey, if you want someone to look at this and tell me if they're getting a good deal, I'll do that. It's
Yeah.
only my time. And if I give you a better deal, this is actually what happened yesterday. I helped the person. I came in about 3/8% lower on an interest rate. And then they sent that estimate, which I took a good, 20, 30 minutes to produce.
Mm-hmm.
And I sent it back to them. And what's interesting is their initial lender dropped their fees and their rate to meet mine. Now, what does that say about that lender? Think about it for a minute.
Yep.
Because they could have offered a lower rate and a lower set of fees
The
in the
first time.
beginning.
Right.
Right. So, like, I think that that's a situation where I often encounter that, but in the end, I've helped somebody out, haven't I? I mean,
Right.
I've made somebody meet my standards, and
Right.
it's a win-win. I mean, of course, I want to close the transaction, but a lot of banks and credit unions, they don't really have a lot of freedom to meet my estimates. They have to do it the way that they've quoted it. So I can't necessarily knock them because they're bigger institutions. They got big bills to pay, and back to what I was saying earlier, we're lean and mean. We're not
Right.
gonna we're gonna compete, and we're gonna better your situation regardless.
Dude, I really love that about being competitive in that arena. I mean, exactly what you said. There are so many opportunities where other lenders could have given their first and best, but they don't. I mean, we're all in it to make money, right? But when we can be transparent and upfront and honest with people, um, those people always succeed, And so I love that about you and what you bring to the table because it just helps us provide the service to our clients and to our customers that we're doing it in a way that they know we're doing it in a good way, right? We are above board. We can feel confident about being honest, and I love that about business. Just honest business will always be successful. So I love that.
Yeah, I mean, I think that, having been a part of this business in many different, situations with banks. I worked with banks before, or with
Mm-hmm.
correspondent lending. I worked in the broker world. And all of those experiences have reduced to what we are right here at HomeQuest Lending, which is, this is our longevity. This is how we stay in business. And this is the best way to treat people. I
Right.
hope that, we can only do so many transactions. I'd love to take on as much as I can, but, also, hopefully there's others that hold themselves to those same standards in our business, for you as a real estate agent, as for me as a lender.
Right. No, I love that. Well, I just wanted to say thank you so much. Thank you for being here. Thank you for sharing your experience and knowledge with us. We can't do this without competent lender partners, and I just love working with you thus far. And so it's amazing. And I just wanted to say thankful and how grateful I am for you.
Well, thank you for having me on this podcast and, involving me with your people. And I'd love to be a resource to you, your agents, and your clients. And really looking forward to that experience over the course of time.
Yeah,
Thank you.
thank you so much. So for everybody listening, I will have John's information down below. Hopefully there will be a link to his second opinion link so that you can get a second opinion on any loan estimate that you got going out there. And then feel free to reach out to him and ask questions about your personal financial journey, because like we've already kind of shown, that everybody's on their own warpath in finances, and there are 1,000 variables to this whole arena of lending. And so without getting the proper information in front of you from John straight to you, it's hard to actually see what path that we can help you out on. So just want to say, everybody reach out to John. This is going to be amazing. And just thank you so much.
Thank you very much. Take care.
All right, this has been another fun episode, Fitness Realty. I am the broker, TJ McClelland, and this was episode 66. Later.